We're going to wind up our lectures this week with the preparation of the financial statements now that we've made those adjusting entries. And this is ultimately going to look very much like the financial statements that you prepared as part of the last chapter's homework. We have our trial balance here, and in the, I don't know, we call this light yellow. I'm not even sure what color this is. But anyway, this is the unadjusted trial balance. And this is what you used in the last chapter when you prepared financial statements. Now, here we are over in the adjustments column, and these are all of the adjusting entries that we have made. And I believe that there is an example in your book that indicates by letter these specific transactions, as opposed to, I think they were numbered when we went through them, but will help you trace these adjustments back to the transactions that resulted in these adjustments. So we've now made the adjustments, and we're going to update the trial balance as a result of these adjustments. Now, our cash, there was no adjustment made to cash, so that number comes straight across. On the other hand, our accounts receivable, we had to make an adjustment to that. So we had $1,800 from that. We used up some supplies, we used up some insurance. So again, these are assets, and the debit entry will result in the asset account increasing, or I should say the debit adjustment. These assets listed below, the supplies, insurance, equipment, or not equipment, but supplies and insurance at least. These are credits, so these are going to decrease the debit balance in these accounts in the adjusted trial balance. So the supplies of $97.20 are going to be reduced by the credit of $1,050 to give us an ending debit balance of $8,670. The same would apply to supplies. Now remember, we had some depreciation recorded, but we didn't record that to the equipment account itself. We have its little companion contra account of accumulated depreciation, where that $300 credit's going to get recorded and then just transferred over here. So in this, basically, if there was no balance initially in the unadjusted trial balance, then all you have to do is just transfer the adjustment over into its appropriate debit or credit column in the adjusted trial balance. If there was a balance in that account, then you need to either increase or decrease that balance based on whether it was a debit or a credit, and then record the new total in the adjusted trial balance in its appropriate account. Now once we, and the worksheet's sort of a handy way to do it, but once we've done that, all we're going to do is take the numbers in the adjusted trial balance and do exactly what we did in the last chapter when we prepared the financial statements. We are going to, and again, we've got assets, and then moves down to our liabilities, and then we have our capital, withdrawals, revenue, and expenses. And we're going to just, again, as we did in the last chapter, prepare those financial statements, starting, of course, with the income statement. So up here on the right is the snapshot of just the adjusted trial balance columns from that worksheet I had just talked about. So we've got all the assets here and all the, or the few liabilities. And again, so again, it's all the same column. But we're going to start with our income statement, and we're going to look at our revenue and expense accounts. And we're just going to pull those right over onto our income statement, and then get our net income at the end of $3,785. We're going to need that net income figure when we move next onto our statement of owner's equity. So again, we're still assuming this is the first month we've been in business, so we don't yet have an opening balance. We have the $30,000 initial investment that our friend Taylor made, plus the income, and that gives us total increases of $33,785 to the owner's equity. But remember from the last chapter, our owner took $200 out, leaving our owner with $33,585. We're going to just take that owner's equity number, wander on over to our balance sheet, and plug that right into our owner's equity. We're then going to wander back up to our adjusted trial balance. We're going to grab our assets and grab our liabilities and just bring those over onto the balance sheet. And then we are going to, of course, make sure that the total of all of our assets, in fact, equals the total of our liabilities plus our owner's equity, and it does. So we know that we are in balance and we are good to go. Now, as with last month, we can then take these financial statements and we can use them to begin to conduct some analysis. And this is the profit margin ratio, and that takes the net income over net sales. And this allows us to compare across companies how those companies compare. Now, net sales, again, being sort of the top line, or well, almost the top line revenue column, and then the net income being what's left after they've paid all of their expenses. So how well do they, how efficiently do they conduct operations so that they can maximize their profit margin? And so we see that Visa seems to be doing a better job than MasterCard. And in fact, while both companies have shown an increase over the past couple of years, Visa has done a better job increasing its profit margin than MasterCard did. And I'm going to stop here. I will not clutter your minds any further with alternatives in accounting for prepaid items. And that concludes Chapter 3.